Subscribe to UK Pensioner Hub for expert guidance on all your pension and tax questions. Are you a UK pensioner wondering if you need to file a tax return this year? You're not alone. Thousands of pensioners across the country face confusion every tax season about whether they need to complete a self-assessment form. The good news is that most pensioners don't need to file a tax return because their tax is automatically deducted through the pay system. However, there are specific situations that trigger the requirement to file, and missing these could lead to penalties or unexpected tax bills. Today, we're breaking down the 7 key HMRC pension triggers that determine whether you need to file a tax return in 2025. We'll explain each trigger in plain English so you can confidently know where you stand. Whether you're newly retired or have been receiving your pension for years, understanding these triggers is essential for staying compliant and avoiding unnecessary stress. Let's start with some essential background information. When you receive your state pension and any private or workplace pensions, HMRC typically collects the tax you owe automatically through the PAYE system. This means your pension provider deducts tax before paying you, just like an employer would with wages. For most pensioners, this system works perfectly and no further action is needed. However, certain financial situations fall outside this automatic system, and that's when you need to take matters into your own hands by filing a self-assessment tax return. The first trigger involves income from self-employment. If you're receiving pension income but also running a business or working as a freelancer, consultant, or contractor, you'll need to file a tax return. Many pensioners take on part-time consultancy work, offer professional services, or turn hobbies into small businesses during retirement. The threshold here is straightforward. If your self-employed income before expenses exceeds £1,000 in the tax year, you must register for self-assessment and file a return. This applies even if you're making very little profit or operating at a loss. HMRC needs to see a full picture of your business activities, expenses, and income. Remember, self-employment income is what you earn before deducting any business expenses. So, if you made £2,000 from consulting work but had £1,500 in legitimate business expenses, you still cross the threshold and need to file, even though your actual profit was only £500. The second trigger relates to rental income from property. If you own property that you rent out, whether it's a former family home, a buy-to-let investment, or even a room in your current residence, you may need to file a tax return. The key threshold here is the rent-a-room scheme limit, which stands at £7,500 per year. If your rental income from a room in your main home stays below this amount, you don't need to declare it or pay tax on it. However, if you're renting out a separate property or your rental income exceeds this threshold, you must file a self-assessment return. This includes income from holiday lets, commercial properties, or land. Many pensioners are caught off guard by this trigger because they assume their rental income is automatically taxed like their pension. It's not. You're responsible for declaring all rental income and claiming allowable expenses like maintenance costs, insurance, and mortgage interest where applicable. The third trigger involves savings and investment income that exceeds certain allowances. Everyone in the UK receives a personal savings allowance, which allows basic rate taxpayers to earn up to £1,000 in interest tax-free, and higher rate taxpayers to earn up to £500 tax-free. Additionally, there's a dividend allowance of £500 for the 2024-25 tax year. If your combined income from savings, interest, and dividends exceeds these allowances, you'll likely need to file a tax return. Many pensioners have built up substantial savings over their working lives, and with interest rates having risen in recent years, it's easier than ever to exceed these thresholds. If you have money spread across several savings accounts or hold shares and investment funds, keep careful track of the interest and dividends you receive. Banks and investment platforms should provide annual statements showing exactly how much you've earned. The fourth trigger concerns the state pension age and when you start receiving it. If you reach state pension age during the tax year, there's often a mismatch between the tax you've paid and what you actually owe. This is because your tax code might not immediately reflect your new circumstances. If you were working before claiming your state pension and then start receiving it, HMRC might not have adjusted your tax code quickly enough, leading to underpaid or overpaid tax. In these transitional situations, HMRC may ask you to complete a tax return to reconcile what you owe. Additionally, if you defer your state pension to receive a higher amount later, the rules around taxation become more complex, and you may need to file a return to ensure everything is calculated correctly. The fifth trigger relates to the high-income child benefit charge. This might surprise some pensioners, but if you or your partner claims child benefit and your individual income exceeds £50,000, you'll be hit with this charge. Many grandparents who still have dependent children or who are raising grandchildren find themselves in this situation. The charge gradually claws back the child benefit, and you must report it through self-assessment. If your income is between £50,000 and £60,000, you'll pay back a portion of the child benefit received. Once your income hits £60,000 or more, you effectively pay back all of it. This trigger catches many people off guard because the child benefit might be claimed by your spouse, but the charge is based on the higher earner's income. The sixth trigger involves claiming certain tax reliefs or allowances that aren't processed through pay. The most common example for pensioners is claiming tax relief on charitable donations made through gift aid. While basic rate relief is automatically applied when you make the donation, higher rate taxpayers need to claim the additional relief through self-assessment. If you're a higher rate taxpayer who regularly donates to charity, you could be missing out on significant tax relief if you're not filing a return. Another example is marriage allowance, although this is typically claimed through simpler means. However, if your tax affairs are complex and involve multiple reliefs, HMRC may require a full self-assessment return to process everything correctly. The seventh trigger covers situations where you have income from overseas. If you receive a foreign pension, rental income from property abroad, or investment income from overseas accounts, you must declare this on a self-assessment return. The UK has a worldwide taxation system for residents, meaning you need to declare all your income regardless of where it comes from. Many pensioners who worked abroad during their careers or who own holiday homes in places like Spain or France fall into this category. Even if tax has already been deducted in the foreign country, you still need to declare the income in the UK. The good news is that double taxation treaties often mean you can claim relief for tax already paid abroad, but you need to go through the self-assessment process to do this properly. Beyond these 7 main triggers, there are a few additional situations worth mentioning. If you receive certain state benefits like job seekers allowance or employment and support allowance, you may need to file a return. If you're a company director, even of a small family company, you'll need to file, regardless of your other income. And if you have significant capital gains from selling assets like shares or property that exceed your annual capital gains tax allowance of £3,000 for the 2024-25 tax year, you'll need to report this. So what should you do if one or more of these triggers applies to you? First, don't panic. The self-assessment system, while detailed, is manageable with the right preparation. You can file online through HMRC's website, use commercial software, or hire an accountant to help you. If this is your first time filing, you'll need to register for self-assessment. You must do this by the 5th of October following the end of the tax year in question. For the 2024-25 tax year, which ends on the 5th of April 2025, you'd need to register by the 5th of October 2025. The deadline for filing your online return is the 31st of January following the tax year. For 2024-25, that means the 31st of January 2026. Keep thorough records of all your income throughout the year. This includes P60 forms from pension providers, bank statements showing interest earned, dividend vouchers, rental income records, and receipts for any allowable expenses. Good record keeping makes the filing process much smoother and ensures you claim all the deductions and reliefs you're entitled to. If you're unsure whether you need to file a return, contact HMRC directly. They can review your circumstances and advise you. It's always better to ask than to assume you don't need to file and then face penalties later. HMRC does send out notices to file to people they believe need to complete returns, but the absence of a notice doesn't mean you're off the hook if one of these triggers applies to you. Understanding these 7 pension triggers puts you in control of your tax affairs during retirement. While filing a tax return might seem daunting, especially if you've never done one before, it's simply a matter of accurately reporting your income and claiming the reliefs you're entitled to. Thousands of pensioners successfully complete their self-assessment returns every year, and with proper preparation, you can too. Remember, staying compliant with HMRC isn't just about avoiding penalties. It's about ensuring you're paying the right amount of tax, not too much and not too little, and claiming all the allowances and reliefs that belong to you. Your retirement years should be enjoyed without the worry of unexpected tax bills or compliance issues hanging over your head. Don't forget to subscribe to UK Pensioner Hub for more essential guidance on pensions, tax, and making the most of your retirement. Hit that subscribe button and the notification bell so you never miss our latest updates. We're here to help you navigate every aspect of your pension journey with confidence and clarity.